Unilever is one of the world's largest consumer goods companies with over 400 brands used by 3.4 billion people. These brands include Axe, Ben & Jerry's, Comfort, Dove, Hellmann's and many more. Historically, Unilever has been a reliable investment. However, the stock has underperformed recently, falling around 5% over the last 3 years. That's in sharp contrast to Procter Gamble, which has risen over 20%. Today, Unilever has a valuation of 118.7 billion euros. It's got 7.6 billion of cash and 24 billion of long-term debt, so the enterprise value is 135 billion. Revenue over the last 12 months was 61 billion with 8.3 billion of net income and 6.2 billion of free cash flow. So Unilever stock is valued at 14 times earnings and 22 times free cash flow. And the company also pays out an attractive dividend of 3.65%. So based on the financials, Unilever looks good. It's got healthy free cash flow and strong operating margins of 19%. And Unilever's revenue is well diversified across various segments: beauty and well-being, personal care, home care, nutrition and ice cream. Many of these products like food, shampoo, detergent are essential items or used on a daily basis. That's why even during the pandemic, the company's revenue was down only 2%. And because people need these products, Unilever is able to raise prices during periods of inflation. So the question is, why has Unilever underperformed? One of the reasons is that Unilever is simply a mature company that is not growing as fast as it did in the past. Net income over the last 10 years has grown at only 6% a year. But the company has also held on to too many mediocre brands and it's cut back marketing spend. CEO Alan Jope stepped down last year and was replaced by experienced operator Heinz Schumacher. And the company also has an activist investor on board, Nelson Peltz. It's worth noting that Procter & Gamble trades at a higher valuation than Unilever despite weaker performance. P&G has grown earnings at only 2.6% a year over the last 10 years and revenue less than 1% a year, but the stock is now valued at 26 times earnings. So the right trade might be to buy Unilever and sell Procter & Gamble. If you assume that Unilever can deliver earnings growth of 5% per year for the next 5 years, similar to what it's done in the past, and then trade at a multiple closer to P&G, perhaps at 20 times earnings, the company would be worth 212 billion euros in 5 years' time. That works out to an investment return of 12.3% per year, and that's without dividends. Once you include dividends, the return might push 15% a year. That's a good return for a reliable defensive company, which is why I give this stock a solid bullish rating. But these are my personal opinions, not financial advice, and I currently hold no position in Unilever stock. For more detailed investing ideas, make sure to visit our website, overlookedalpha.com.